So this question number 26 had some concepts from the International Financial Management chapter regarding the nominal rate and the real return. What we want to do is, half of the question can be solved now, but for the rest of the half, we will need an understanding of that nominal rate of return. What we can do now is, let's complete. First three parts can be completed. The last part has to be kept for the chapter of International Financial Management. So let's have a look on this question now. I was about to skip this question, but then I think we can easily do it. A US investor chose, it's a past. See, this is a year and we are standing at this point, that is at the end of the year. A year back, we chose to invest in Sensex. This is a US investor. His home currency is dollar. For a period of 1 year, the relevant information is given below. He invested $20 lakh. He came to India with the dollar. He sold the dollar and bought rupees. The base currency in this case is dollar itself. So let's put a requirement in dollar. We want to sell the dollar. That means the bank will buy the dollar and the buying rate is 42.50. So when you will multiply, because this is in dollar and this is in rupees, we will multiply both of them. 20 lakh into 42.50 goes to 8.5 crore rupees you are going to invest. So what you did, you invested 8.5 crore rupees in the Sensex 1 year ago at a rate of 8.5 crore. So 8.5 crore rupees divided by 3256 rupees of the Sensex. So the number of Sensex is 26105.65. That is what you purchased. Okay. What happened after 1 year? Sensex now means after 1 year is 3765. So you are going to multiply it with 3765, the current rate, and the result will be 9,82,87,776. How much you invested? 8,50 lakhs. Doesn't matter. Now what are you going to do? As an US investor, you will sell this rupees and buy dollar after 1 year rate. The spot rate now means today's rate after 1 year. This is all 1 year ago and today. So you will sell that rupees and buy dollar. Right? If you want to buy dollar, since dollar is the base currency, I will put a requirement in dollar. I want to buy dollars. Bank will sell dollar. The selling rate is this much. Not just 90, it's 43.90. This is the way rates are quoted. So divided by 43.90. How much dollar I will receive? 223,891.51. Okay, this is what I received. How much I invested? 20 lakhs dollar. 20 lakh dollars I invested. So minus 20 lakh. The gain is 238,901.51. So if I divide it by 20 lakhs, multiplied with 100, the rate of return is 11.945%. This is how much I earned on dollar as a US investor. So compute the nominal rate of return to the US investor. It comes to 11.945%. You got it? How did we calculate? We first converted the dollar into rupees. Then that rupees was invested at the Sensex at 1 year ago prices. Then the same was converted. The number of Sensex that we purchased, units of Sensex that we purchased, is now converted into the current price 3765. Then the amount that we have received by selling the Sensex was converted at the current spot rate of dollar, which is 43.90. The major part of your practice will be to choose these rates. If you are wrong at selecting the exchange rate, whether the bid is applicable or the ask is applicable, then you will end up putting a wrong answer. 43.90 divided by 43.90, so you received $22,38,901, and then the gain is possible. See, 8.5 crore invested at 3256, 26,105 units multiplied by the current Sensex price. This was the amount that you sold at the current spot rate, and you received the dollar. So you received this much after a year, invested this much before a year. The gain is this much on 20 lakhs, that is 11.94% in the entire year. Cool. Compute the real depreciation or appreciation of rupee. Now, this is something from the International Financial Management chapter, but I think you will be able to understand, so it's very easy. See, consider the bid rate. That's enough. 42.50 at 0th time and 43.85 at the end of the first year. And we know that because of the inflation, forward rate will get impacted, right? Let's just find out. 1 plus ID divided by 1 plus IF. We have to calculate it in rupee. So we have to calculate the real depreciation or appreciation of rupee. That is the base currency. Not the base currency, that is the price currency. Okay, forget that. But we have to calculate it in real terms. What does that mean? It means that you can remove the current inflation from 43.85. You agree that 43.85 consists of the inflation. I will just take it here. This is the spot rate, this is the spot rate. So this 43.85, since 1 year has gone, 42.50. According to purchasing power parity theory, based on the spot rate, we can calculate the forward rate. If this is the forward rate, the inflation of both the countries are included in it. What you can do is remove the inflation from that, and the rest of the rate will be considered as the real rate without any impact of inflation. So what I can do is 1 plus ID divided by 1 plus IF is equal to F by S. Now ID 1 plus rate of inflation in our country is 9%. So that's 0.09 divided by 1 plus 0.05 is equal to forward rate is 43.85, and we want to calculate the real rate. So what we are doing now is we are removing the inflation from this, the impact of inflation, and we will reach at 43.85 into 1.05 divided by 1.09. So it comes to 42.24. 42.24. See, without inflation, 42.24 is the rate at the end of year 1. So if you calculate the premium or discount between these two rates, you can clearly see that this will be without impacting any inflation. That means this is the real appreciation and depreciation. This includes inflation. Now you can clearly calculate the appreciation, because you can clearly see that the dollar was 42.50 a year back and now it is only 42.24. The rupee value has appreciated because you are paying less amount of rupees to buy the same item. And we have removed the inflation. We have removed the inflation from this part. Do you agree? So the difference between these two will be the appreciation in rupees. See. So what we did first is we calculated the real exchange rate, that was 42.24. We removed the inflation part. And then we find out the difference between the current spot rate at year back, spot rate a year back, and spot rate today. And that's when this is the real appreciation. Earlier you used to pay 42.50 for $1. Now you are paying only 42.24 for the same dollar. So the appreciation in rupees 0.61%. One thing to note that if you really go with the rupee appreciation and depreciation, the formula will go like this: S minus F by F, and accordingly 42.24 should have been in the denominator. But just go with this formula. Institute is not recognizing this. So for the purpose of marks, you need to follow what the institute has done. So according to me, this is clearly wrong to take 42.50 in the denominator. But I don't know why the institute is not recognizing the real or the correct approach. You can go to internet, you can discuss with anyone. If someone says that this is wrong, I will quit teaching. But for the marks purpose, you need to follow this only, 42.50 in the denominator. So basically they are just comparing the spot rate in both the cases, in the rupee also and in the dollar also. That means in the price currency also and in the base currency also. Okay, so 0.61% becomes the exchange rate, the real appreciation in rupee. This does not include the inflation. That's okay, we will just know about it later on. What should be the exchange rate if relevant purchasing power parity holds good? It's very easy. For buying and selling, you can calculate. See, in this part also, when you asked us about appreciation and depreciation, this is the real appreciation and depreciation of the bid part only, not the ask part. Yeah, 42.50 and 43.85. You can take 42.60 and 43.90 as well to calculate the appreciation and depreciation. So both the answers will be okay. Now, if they are asking us to calculate the relevant foreign exchange rate with purchasing power parity theory, it's absolutely fine. You can take 42.50 as the spot rate, then 1.05 and 1.09. Then 42.60 as the spot rate, 1.05 and 1.09. See, 42.50, 1.095, this is the bid rate, buying rate. Then 42.60, 1.09, 1.05, this is the selling rate. So this should be theoretical exchange rate, forward rate. This should be the theoretical rate today after 1 year, 44.12, 44.22. And you can see that it is only 43.85 and 90. The purchasing power parity theory says that this should be the rate, 44.12 and 44.22. Instead, the actual rates are much lower than the theoretical rates. There is an arbitrage opportunity in this case. This is what we will postpone it. And in fact, you can take it as homework after we discuss the international financial management chapter. See, whole and soul, the only logic that we need to learn for solving this part is this. You will get to know about it. 1 plus nominal rate of return is equal to 1 plus real rate of return is equal into 1 plus inflation rate. So inflation rates are here. Nominal rate will also be given. You can easily calculate the real rate. And that is what you are going to learn in the next chapter. So what will be the real rate of return? When the question says real rate of return to an Indian investor for Sensex, what you are going to do is the difference between these two will be considered as nominal return. Once you calculate the nominal return, you remove the Indian inflation rate out of that. I will just show you. Consider that you know this formula and we are just going to apply the formula and you will get an idea about it. See, the nominal return is the closing Sensex and minus opening Sensex divided by the opening Sensex. So basically this is nothing but the return of the Sensex in 1 year, right? Now understand the logic. By passing through the entire year, you have earned 15.63% in investing by investing in Sensex. But because 1 year has gone, you would have all your cash flows or your return is also impacted by inflation, which was 9% in India. So practically speaking, the real value of 15.63% will be calculated when you will remove inflation out of it, right? So what we can do is 1 plus nominal rate of return is equal to 1 plus inflation rate in bracket 1 plus real rate. Put down this formula and you will get the values. 1.1563 we will assume that 15.63% includes all the inflation and real rate, and the inflation rate was 1.09. Now you can calculate the real rate. So if you will take that 1.09 on this side, the equation will become like this, and the real rate will be 6.08%. Means besides inflation, in reality you have earned 6.08%. So we can say that this 15.63% contributes to two things: the real return and the inflation of 9% and 6.08%. So you cannot simply add both of them, because the inflation also impacts the principal, not just the return. So you will have to do it 1.09 into 1.0608, and then you will reach at 15.63%. So you will learn more about it in the next chapter. Okay, consider this question number 27. Yeah, this is very easy. You remember that question? I think that was the first or second question where I taught you the formula. Yeah, this formula. What was this formula? Sir, 1 plus return in home country is equal to 1 plus return in foreign country in bracket 1 plus minus change in exchange rate. Did we learn that? Exactly the same you are going to use now. So question is asking you to calculate the return in home country. First you are going to calculate the return in foreign country. Then there are three different changes that you are going to apply at this. First, 0, no change first. Then the second one is 3% appreciation. Third one is 3% depreciation. So when it is appreciation, you are going to add. When it is depreciation, you are going to deduct. Let's have a look on this question now. See, Mr. Mamen, an Indian investor, invested in the USA. If the price of the bond when he invested was $100 and it is $103 at the end of the year, the coupon rate is 3%. Since he has invested in the bond is paying interest. You can look at it with the help of the timeline. 100 rupees put here has become 103 plus $3 of the interest. So the net dollars or cash flow that you will receive is 106. You can clearly see that the return on the investment in terms of home country currency. So first of all, return in terms of foreign country currency is 6%. Do you agree with this? The return is 6% in foreign country currency. Now, the return in foreign country currency. If the USD does not changes in the entire year, we have to calculate it in the home country currency, right? So keep this formula ready. You don't have to do all these things. 1 plus return in home country is equal to 1.06, the foreign country return, in bracket 1 plus 0 change. Since the USD has not changed, it is flat. So automatically 6% becomes the return of the home country. This is your first answer. If the USD does not changes, the return of the home country is equal to the return of the foreign country. But if it appreciated during the year by 3%, it's very simple, sir. 1 plus 0.03, 1.06 into 1 plus 0.03, 1 plus 0.6 into 1 plus 0.03, and you will get 9.18%. What if it depreciated by 3%? Obviously, it's very easy. Instead of plus, you just do 1 minus 0.03. So basically 1.06 into 0.97 is what you are doing, and that will give you 2.82%. Now the next part. Indian rupee appreciates during the year by 5%. They are not saying USD is appreciating. They are saying exactly the opposite currency is appreciating. Practically speaking, if you go by the logic, if Indian rupee is appreciating by 5, dollar will be depreciating by some other percentage. How to calculate that? There is no need to first of all calculate. One thing that to keep in mind is the appreciation in Indian rupee will not be equal to the depreciation in dollar. That is for your practical knowledge. But Institute has again failed to recognize this in this question as well. So you also have to ignore it for the purpose of marks. What institute did is, since rupee is appreciating by 5%, dollar is also depreciating by 5%. So they just deducted 5%, similar to what they did in the third part. 1 minus 0.03 it was, now it is 1 minus 0.05 because dollar is depreciating. See what they have done. 1 minus 0.05. That's totally wrong. 4.76% is the real value of depreciation of dollar when it comes to 5. Like when the rupee is appreciating by 5. I can take any figure. Let's say for example rupees per dollar is 50. Since rupees is the price currency, and it is appreciating by 5%. How you will do it? You are going to reduce the values because rupee is appreciating. So 50 divided by 1.05 will be the answer, because 5% is the appreciation. 50 divided 1.05. So you can see 47.62 is the answer. 50 and 47.62. When rupee is appreciating by 5%, this is the change. So what will be the change in the dollar? Dollar is depreciating from 50 to 47.62. 50 minus 47.62 divided by 50. That comes to 4.76%. So dollar is depreciating by 4.76%. Still institute has failed to recognize that. I don't know why. Means this is not so technical to understand, but still they have failed it. You can do all the research on your internet and you will find out that 4.76 is the correct answer in this question. Now the fourth part is what should we do in exam? We should follow institute for the marks. Will your answer differ if Mr. Mammon invest in bond just before the interest is payable? No, sir. It is not going to affect our answer. Why? Because even if you are investing just before the interest is payable, still you will be eligible to receive the interest. That means the net amount that you are going to receive at the end of the year is $106. So if that is same, then there is no change in the answers. So no, our answer will not differ even if Mr. Mammon invest in bond just before the interest is payable, because obviously the days will matter. If you are investing for 1 month only, so all the rates will become for 1 month, but the figures will not change. Okay, so let's start with question number 28. This question number 28 is important from the point of clearing the two concept or strengthening the two concept, which is appreciation and depreciation in a currency and the interest rate parity theory. So we will solve it thoroughly. You can mark it. Have a look. The following table shows interest rates for the United States dollar and the French franc. Okay. So Indian rupee is not in this particular question. There. The spot exchange rate is 7.05 franc per dollar. You can clearly see the spot exchange rate. Spot rate is franc per dollar. So it is like this. French franc per dollar 7.05. And this entire question, no data related to the home country and foreign country is given. That means it is not clear which country is home country and which country is foreign country. So whenever there is such kind of a situation, whenever the situation is like this, what you should do is, whatever the rate is given in the question, assume that as a direct quote. Once you assume it as a direct quote is always home currency by foreign currency, where foreign currency is the base currency. So in this question, in this quote, we will assume French franc as the home currency and dollar as the foreign currency. Why? Because we have assumed this quote as a direct quote. Unnecessarily, unless and until given, we are not going to assume it as indirect quote. Okay. So going by that, we can clearly say the dollar interest rate will be RF, that means foreign country rate, because our home country is France. So, and the domestic rate will be French franc. Okay, sir. Complete the missing entries. You can see that we have been given with the interest rate of dollar and franc, and then forward rate F is also given, and forward discount per franc percent per year. So the discount in the franc is given to you, and franc is the price currency. What is the formula for discount in the price currency? Discount or appreciation or depreciation in a price currency? Price currency. It's spot minus forward divided by forward into 12 by n into 100. Because this is per year, that's why we have to convert it into 12 by n. N is the number of months. Okay. So we will go one by one. First we will solve for 3 months, then for 6 months, and then for 1 year. Later on I will explain the answer given by the institute, because institute has little bit messed up with the answers. So I will make it simple and clear. So let me just remove this first. Question number 28. Okay. First we will take 3 months data. And you know one thing, when you take it as 3 months, the rate has to be converted into 3 months. So you can see that 11.5, 11.5% means 11.5 divided by 4. So this is the rate for 3 months, 2.875, and 19.5 divided by 4. This is the rate for 3 months, 4.875. In this case, it will be 12.5 by 2, that's 6.25. So I've just written it here so that whenever I take the values from the column, I should take it properly. So for 3 months, the very first thing that we have to calculate is the forward rate. The forward rate we can calculate using interest rate parity theory. Have a look. One plus RD, 1 plus RF forward by spot. So for 3 months, RD is 4.875. 1.04875 divided by 1.02875 forward rate, foreign currency rate, interest rate. Forward rate is what we have to calculate, and the spot exchange rate is 7.05. So if you solve this equation, you will get the answer as 7.19 franc per dollar. This should be the forward rate for 3 months. Okay, done with the first part. Now second part. In the second part, they have asked us the forward discount on the franc. So we can calculate this using this formula. Only 2 formulas have to be used in this entire question. One is the interest rate parity theory, and the other one is this one. So forward discount in franc, write down in bracket price currency. S minus F divided by F into 12 by N into 100, because we have to calculate it for entire year. Spot rate is 7.05, forward rate is 7.19. You have just calculated the same. 12 divided by how many months? 3 months into 100. It's that easy to calculate. This is going to be minus 7.79%. It should be in minus. So one thing that you have to change is keep it minus here, because I think there is some printing mistake. It has to be minus. I remember that. And so it should be minus. Okay, so are we done with the 2 answers? Yes, sir. What are those answers? 7.19 and 7.79 minus percent. These are the two answers for 3 months. In the similar way, we should do the calculation for 6 months. Now understand that in the 6 months category, franc interest rate is not given and forward franc is also not given. So two information from this formula are missing. So we cannot use it first. We will have to use this formula first and calculate the forward rate. Using this forward rate in the equation, we can calculate the RD. Okay, I will just solve it. Have a look. In the second part, we will go with 6 month. And this time I will start with forward discount. Instead of writing everything, I will just go with the formula directly. 1 S minus F by F into 12 by N into 100 is equal to minus 6.3%. Am I right? 6.3% minus. Since it is a discount, we have to keep it in minus. Spot rate is 7.05, forward rate is unknown to us, into 12 by 2 into 100. Am I right? So minus 6.3. Now if you will transfer 100 on that side, it will become in the denominator. It will come in the denominator, and 12 by 6 will be taken here because of 6 months. So 12 by 6 is 2. 2 will also go on that side and will come in the denominator. So it will look like this: 7.05 minus F divided by F is equal to 6.3 divided by 100 divided by 2, that is 0.0315 negative. So 7.05 minus F is equal to minus 0.0315 F. Now if you will transfer this minus 1F on that side, it will become plus 1F. So 1 minus this value will be the result. Point 9685 F. Now you can clearly see forward rate is equal to 7.28. So this is your first answer. 7.28 is the forward rate. You can write it here. Now with the help of this forward rate, dollar interest rate and spot rate, you can calculate the franc interest rate using IRPT. See, using interest rate parity theory, 1 plus RD, 1 plus RF is equal to F by S. What is the RD? That is what we have to calculate. What is risk-free rate? Foreign RF means risk-free rate of interest. It's foreign country interest rate. So that's 6.25. Can I keep it 1.0625? Please remember to take the rates only for the period that you are calculating, that is 6 months, because per annum rates are given. By mistake, if you take per annum rate now, the answer will be wrong. 7.05. Let's solve this. 1 plus RD is equal to 1.0972 and RD is equal to 9.72% for 6 months, because you have kept 6 months values in the formula. So the result will also be for 6 months. We can simply multiply it by 2. 19.44% for 12 months. Simple. So 19.44%. Easy. In the similar way, we have to do the calculation for 1 year, and I am leaving that to you. See, the very first thing that you will calculate is, now in the third part you can use any formula first, like you can use the IRPT also and calculate the forward RF in that, and you can use the S minus F or F divided by F into 12 by N formula to calculate the discount as well. Both the things are possible. Let me just do it fast for you. 1.6 7.52 divided by 7.05 into 1.06 na, so divided by 1.20, just a second, 1.20, yeah, 7.05 into 1.20 divided by 7.52, 12.5% will be the answer for this, and 7.05 minus 7.52 divided by 7.52 into 100, 6.25% is the answer for this. Now you can cross check the answer, but let's go through Institute's answer. Institute has messed up at many places. So let me take the first 3 months. For the first 3 months, the answers are 7.19 and 7.79% negative. So this is correct for the Institute, 7.19, and instead of 7.79%, they have simply taken 8%. That means the interest rate differential, the difference between two. So practically saying this is also correct, but this is approximately correct. I told you that the forward premium or discount is approximately equal to the interest rate differential. So without using any formula and all that, what they did is calculated the difference between the two interest rate, and that comes to 8%. So this is approximately correct, and this is perfectly correct that we have calculated, and both the answers can be written in the exam. So that is what you need to remember. Second thing, this is totally wrong. Don't go with this 7.04 because they have taken the base of 0.142 for the 6 months. Okay, let's go for the 6 months. For the 6 months, our answers are 7.28 and 19.44. So this is 7.28, and why 19.17% is their answer? Let me just check once again. There might be something wrong from my side as well. $19.44 or 19.43% should have been the answer. So that might be due to some rounding of error. 19.44% or 43% should be the answer. You can cross check with your own calculation even if you solve this equation. For 1 year it is 7. So for 1 year it should be 12.5%. This is just a correction, highlight, and 6.25%, right? All the values are written here. So according to me, this should be the only two answers which are not perfect according to the institute is 7.79 should have been here and 19.44% should have been here. Otherwise, all the other answers by the institute are correct. Okay, sir, let's move on to the next question now. This is going to be an interesting part once again. Question number 29. Let's have a look on that. A German subsidiary of a US-based multinational company, but a German subsidiary of that has to mobilize 1 lakh euros working capital for the next 12 months. It has the following options. It can take loan from the German bank directly. So you can clearly see that we need 1 lakh euros for working capital purpose. German subsidiary. We can take it from our home country. So Germany comes under the Europe continent. The currency of that can be said as euro as well. Okay. So we will see euro. US parent means we are borrowing the money in terms of dollar and then converting that to euro. In a sense of 1 lakh euros we need. Loan from the Swiss bank. If we take the loan from the Swiss bank, it will be CHF that we are going to borrow, Switzerland franc, and then converting it to euro. So the interest rates per annum are given to you, and we need it for 12 months as well. So there is no need to convert the interest rate. That will make the answer easy. Banks in Germany charge an additional 0.25% towards loan servicing. So it will become 5.25%. Am I right? Only in Germany. Loans from outside Germany attract withholding tax of 8% on interest payment. How to treat this? Okay. Interest payment means this 4% and this 3% is itself an interest. So 8% on that will be the tax. So we will have to pay a little more towards it. If the interest rate given above are market determined, examine which loan is the most attractive using interest rate differential. See, the very first one is easy. 5% from the bank and 0.25% is the service charge, and that too it is directly in the euro. So 5.25%. Now come to the second part, loan from US parent bank. Understand that the loan from US parent bank will cost you 4%, but at the time of paying payment of the interest, you will have to pay 8% withholding tax to the government as well. That means after making the payment of 8% to the government, the bank should get 4% of their interest. So you cannot deduct 8% or add simply 8% in 4%. No, it's not like that. See, I will tell you how the calculations will go in this. Question number 29. We will take some hypothetical figure and we will then explain what happens actually. Let's say, for example, this is in dollar, right? Let's say dollar per euro rate is 1.20. Okay. And we need 1 lakh euros, right? If we need 1 lakh euros, how many dollars we have to borrow from the US bank? We will have to borrow around $1,20,000. The moment we will borrow $1,20,000 from the US bank, we will convert that at this rate of 1.20 and we will get euros of 1 lakh, which we can use for whatever purpose we want. Okay, that's clear to you? Now, since we have borrowed $1,20,000 from the US bank, we are going to pay around 4% interest on this. The 4% interest that should go to the US bank is $4,800. Now, please understand that before this interest, we have to make the payment of principal as well. First of all, then we have to pay 4% interest, but the withholding tax is 8%. Now, withholding tax is the tax applied on the net payment made. If you apply 8% on 4,800, it will come to 384, but this will be wrong. Why? Because 384 plus 4,800, now the payment has become 5,184. The government, US government will say that the withholding tax is normally applied on the payments and the payment is 5,184. So you should pay 8% of 5,184, which includes the TDS. This TDS means withholding tax. So applying 8% on directly on the interest will not solve the purpose at any point. Now, if you will calculate 8% on 5,184 now, and you will replace it here, this value will change automatically. So what you have to do is consider this as 92%, this as 8%, and this as 100%. So 384 will be wrong. Calculating 384 will be wrong directly because the withholding tax is applied on the payment, the outflow to us, not the only amount of interest paid to the bank. So consider this as 92%, this as 8%, and this as 100%. Okay. So what you have to do is you have to divide 4,800 by 92%. The 4% interest divided by 92%, and that's what is done by the institute here. 4% divided by 92%, so that they can come to 100% value. 4,800 divided by 92% comes to somewhere around $5,217.40. Okay, let's just forget about the decimals now. And on that you are going to pay 8% interest, which comes to, withholding tax, which comes to 417.39, like this. So after paying 417 from 5217, the balance left will be 4800, which will be given to the bank. So understand that this will go to the bank as principal payment, this will go to the bank as the interest payment, and this will go to the government. And the total payment to you will be 1,20,000 and 5,217, or 1,20,000, 4,800 and 417. So let's calculate the total amount of cash outflow. The cash outflow to you at the end has to be $1,20,000 as a principal repayment, $4,800 as the interest, and $417 as the withholding tax. So the total outflow will be $125,217. Now in terms of dollars you have the cash flows, right? But you want to calculate your total cost in terms of euros. Now we have been given with the interest rates of both the countries. We have the spot rate. We can easily calculate the forward rate at this point. How? 1 plus RD 1 plus RF is equal to F by S. This is the formula. Which is our domestic country? Euro. Germany is our domestic country and the currency of that country is euro. So euro rate will become the domestic rate, which is 5%, and US rate will become the foreign currency rate, which is 4%. So can I write it like this? 1.05 divided by 1.04, forward divided by spot rate was 1.20. Am I right? Acha, spot rate was indirectly given to you in this, because euro is your home currency and euro is the base currency in this equation. This is an indirect quote, and for indirect quote this is not the formula. For indirect quote the formula has to be reversed. So for indirect quote the formula will be 1 plus RF 1 plus RD F by S. So 1.04 1.05 is equal to F divided by 1.20. Am I right? Indirect quote, because euro is our home currency and euro is the base currency in the quotation. That is indirect quote. Indirect quote formula for IRPT is this. Now if you will calculate forward rate, it will come to 1.18857, or we can say 1.1886. Right. So 1.1886. This is dollar per euro. Now what are you going to do? Divide or multiply? Divide, sir, because 125,217 is also dollar and 1.886 is also dollar. Let's divide it. That comes to euro 105348. Right? Now the final two figures to you are like this. You borrowed 1 lakh euro and you paid 1,05,348 euros. So the net interest cost to you in terms of euro is very simple, sir. 1 lakh was required and you paid 1,05,348 minus 1 lakh. So that's around 5.35%. Why 5.348%? Rounded off to from 5.34%. 35%. Do you get that? It's very easy to understand, sir. All these figures have been, this 1.2 has been assumed by us. You can assume any other rate. The final answer will not change, 5.35%. And do you understand this? 4% divided by 92%, because 8% of the withholding tax. Withholding tax is a term which is treated as a TDS. So TDS is applied on the net payment. So 5217 will be the amount on which 8% will be applicable and not this 4,800. That is what you need to understand. Institute has done everything perfectly, but they have made one mistake in this part. What mistake was that? The mistake is that, see, this one is correct. 4.35% is the total cost to you. If you will calculate, see, I will tell you. This is your total cost in terms of dollar. So if you will do 5217 divided by 1,20,000 now, it will come to 4.35%. Exactly what the institute has calculated, right? 4.35%. So the balance out of 5.35, 4.35 is the interest cost in terms of dollar. The balance is the exchange rate difference, and that can be easily calculated as the difference between the exchange rate. See, we do not need the forward and spot rate in the equation. We can easily calculate that difference with the help of the interest rate differential, and that's what the institute is asking us. Institute is asking us to take the interest rate differential. How to take the interest rate differential? It is simply 1 plus RD divided by 1 plus RF. What is that? Sir, 1.05 divided by 1.04. You can see it is 1.0096. If you deduct that 1 which you have added in the beginning, you can calculate it as 0.0096. That is 0.96%. That is what additional depreciation of the Germany's currency will be, because Germany's rate is higher, 0.96%. What does that 0.96% explains? 0.96% will be the depreciation in the currency of the country which has high interest rate, and appreciation in the currency of the country which has low interest rate. Okay, we have to think from the angle of the Germany. So our currency should get depreciated by 0.96%. True. So this 0.96% is also right. 4.3135 is also right. 0.96% is also right. But they have made one mistake. They have simply added 4.35 with 0.96%. See, this 0.96% impact was given only on the principal amount. So this is principal, let's say 1, and this is interest, which is 0.0435%. What institute has done is 0.96% of the cost was added to this one only. So we applied 4.35% on 1, that is principal, 0.96% on principal as well. Whereas at the end of the year, when you will convert the cash flows with this much of the depreciation in the currency, all the cash flows including principal and interest will get converted, and it will be costlier to you by 0.96%. So practically speaking, what institute has missed out is this 0.96% is also applicable on 4.35% of the interest cost. So practical way of solving this equation, solving this solution is 1.0435 multiplied by 1.0096 comes to 1.0535 minus 1 minus 1.0535, that is 5.35%. See, without knowing the spot rate and forward rate, we have come to the exact answer of 5.35%, which we calculated in this part. So all in all, what I want to say is institute should understand that if you borrow $1 at this point, the cost of the interest cost of the $1 will be $4.0435 at the end of the year. But do not forget to make the repayment of that principal as well. So that $1. So the total amount of dollar that you have to pay is 1.0435. And in this period, the Germany's, or we can say the euro is getting costlier, or euro has depreciated by 0.96%. So all in all, what you have to do is add 0.96% of the euro's impact on entire 1.0435. That comes to 1.0535, and when you deduct that 1, it will be 5.35%. This has to be the calculation. But what institute has done is they showed $1 as the payment here, and instead of, they forgot about the interest. I don't know why. And 4.35, yeah, what they did is they simply added 4.35% plus 0.96%, that is 5.31% to it. So that ultimately remained 1.0531, 5.31%. So understand what is happening. In this case, when you are applying 0.96%, it is getting applied on the principal and the interest as well. And in this question, in this equation, 0.96 is applied only on the principal, not on the interest. But that is not going to happen. Exchange rate, when it is applied on a certain cash flow, that has nothing to do whether that cash flow is of a principal in nature or interest in nature or receipt in nature, payment in nature. It is given to my grandparents or my father or mother or wife, anyone. It has nothing to do with the nature of the cash flows. Whatever will be the cash flows, all the cash flows has to suffer the impact of 0.96%. Institute has missed out the impact of 0.96% on the interest, and that's why this answer is not perfectly right. Do you understand that? Similar is what will be the situation when it comes to Swiss bank. 3 divided by 8%, that is perfect answer, 3.26%. And this is the premium interest rate differential between the dollar, between CHF. It should be CHF and euro, that is 1.05 and 1.03. But the equation should have been like this: 1.0326 multiplied by 1.094. So what you do when you applied 1.0194, when you do it like this, it means you are applying 1.94% on the interest cost as well. That comes to 1.0526 per 1.0526, that is 5.26% per annum. So this is the most appropriate answer in this case. You can discuss this with your colleagues, friends, other teachers as well, and you will get the same answer. Do you get that? 5.26%. So the most appropriate answers are 5.26%. Or even if you don't believe on these calculation, you can put any figures. Take some spot rate by your own and take some figures and then try solving it. I just showed it to you here as well, that the net interest cost in terms of euro is 5.35%. 1.20 is the spot rate that I have assumed. You can take any spot rate and the answer will still be the same. Okay, sir. So this was question number 29. I hope you have understood. Let me just go through the note. Impact on interest. Have a look on this question. Question number 30. Pretty easy one. This is related to the arbitrage. USD $10,000 is lying idle in your bank account. I think we are starting with the arbitrage part from this question. Let's go through the concept notes first. Yeah. So till question number 29, it was all about the interest rate differential, IRPT, appreciation, depreciation. From this point onwards, we are starting with the currency arbitrage, and we'll go with the currency arbitrage till this point. Good. So a lot of questions with the currency arbitrage. You need to understand it carefully. Let's say $10,000 is lying idle in your bank account. You are able to get the following quotes from the dealers. See, euro per USD, euro per GBP, GBP per USD. Is there any opportunity of gain from these quotes? How to decide? See, what you can do is, the very first thing in arbitrage is you have USD with you. So keep any one USD quote as it is. You can keep it this one and then calculate the same euro per USD, euro by USD from this cross currency, cross rate. So one direct rate and one cross rate for euro USD. Okay, this has to be written in the form of ISO format. So $1.1539 per euro. Okay, this is how we should read it. Now let me show you how to start the arbitrage transaction. It's very easy, sir. Whenever you have been given with such a data, you should keep one rate direct and the second one has to be calculated in the form of a cross rate. So let's keep euro USD 1.1539 as it is. Okay. Now we will calculate the cross rate of euro USD from the other two markets. How to do that? It's very simple, sir. Euro has to be kept first and the other currency is GBP. In order to cancel the GBP, I will start with GBP and then I will keep USD. See, understand, euro is first, USD is last, USD is last, and the common currency GBP is the base currency in one quote and the price currency in other quote. Okay. Now let's write down euro GBP rate. This is euro GBP rate 0.9094 and GBP USD rate. See, this is also GBP USD rate. That means we do not have to convert. We don't have to convert a direct quote from indirect. 1.2752. $1.1597 rounded off. Now understand that the base currency is euro in both. If you go from this market or that market, right? The base currency is euro. Euro per USD, if you directly want to buy euro or buy or sell, because single rate is there, so the same rate will be used for buying and selling as well. So if you want to directly buy euro with USD, then it will cost you $1.1539 to you. But if you go through these two markets and then buy euro with USD, it will cost you 1.1597. You can clearly see that it is costing you more to buy euro in the cross rate. Buy euro through cross rate is being costlier. So are you going to buy the euro from direct market or through the cross rates? It's very easy, sir. We will buy it from the direct market. We will buy it from the direct market because we can see it is cheaper in this. That's it. This is how you have solved the equation. Buy euro in this market and automatically means sell euro at whatever rates in the cross market. Do you understand this situation? First part is to calculate the direct rate of this euro per USD. And why I took USD in my calculation, because I knew that I have dollars lying in the bank account. So I have to keep one quote which includes dollar as it is. So I took euro USD 1.1539 from the direct market and I tried to calculate that what if I do not borrow directly from this market and instead buy the euros from this market. Then I've calculated the cross rate for the same quote, euro USD. I have two rates now. If I want to buy euros, it will cost me this much USD in this market and this much USD in this market. I can clearly see that I'm getting euros at a cheaper rate in this market. So ultimate decision is buy euro at this rate. Once you have decided that at whatever rate, what exactly you are going to do, buy or sell, then it is very easy for you to solve the question. Let's have a look. Arbitrage transaction. Buy euros at EUR USD 1.1539. See, you have $10,000 with you, and the rate is also 1.1539 in dollars. So both the values are in dollars, US dollars. So that's why we are going to divide it. Now we have around 8666 euros 0.26. Now what we are going to do, it's very simple, sir. Sell those euros in the other market. We have completed this part, cross it. Now you can clearly see the euro is only available in the second market, B market, euro per GBP. Oh sorry, euro GBP 0.9094. Euro GBP 0.9094. See, you have euros 8666.26 and the rate is 0.9094 in terms of GBP. We are going to multiply it this time because both the currencies are different. 0.9094. That comes to pound 7881.10. Okay. Now you have pound. Sell GBP at GBP USD rate in the third market, which is 1.2752. You know that you have GBP 7881.1 and the other value is in dollar. Both the currencies are different and we will multiply it. You will get the dollars back at 10050. And you can clearly see that you have an arbitrage gain. You invested $10,000 and receiving $10,050 back. So the arbitrage gain is $50. Simple calculation. This is very easy. You will keep on buying in one market, selling in other market, buying in one market, selling in other market. But the very first part, which was the most important one, was to decide that you have to buy euro at this rate. What if you would have sold the euro, sold the dollar, or we can say bought the GBP at this rate? Because you had dollars with you, right? You could have sold the dollar in this market and bought GBP. That would have led to loss to you, not a gain. So for that purpose, it is very important to understand that whatever the currency is, which currency is cheaper in which market. We picked up euro because it was attached with the dollars and we had dollars to trade for euro. And we found that euro is cheaper in a direct market rather than through cross rate. And so we bought the euros from a cheaper market and sold it in a higher market. That's how we decided. We will take some more questions in order to have some more clarity on how to decide the arbitrage transactions. This was question number 30. Let's come to question number 31. I will take this one as well, I'm keeping this particular problem as homework to you because it is exactly similar to what we have done here. Exactly similar. I will take the other question, that is question number 32, which had some calculations. Have a look. See, Bharat Silk Limited, an established exporter of silk material, has a surplus of $20 million. So what exactly they have is the dollar. In case we have to do some arbitrage with these dollars, we need to make sure that one of the quote rate should include dollar in that. Okay. So as of 31st May 2015, the banker of the company informs the following exchange rate that are quoted at 3 different Forex market. And you can clearly see that London, Mumbai, New York. And one quote is GBP INR, another one is INR GBP, USD INR, INR USD, USD GBP, GBP USD. So one is direct quote, another one is indirect quote. Okay. I don't know why the institute has given it like this, but they have made students very, like, they have created a confusion in the minds of the student that exactly which rates to pick, because when you convert a direct quote to indirect quote, there arises the rounding of differences. And looking at the answer, institute has taken only direct rates. That's it. These three rates have been taken by the institute. Now you can take any of the three rates and solve the question, but ignore the other one. Since this is an RTP related question, not exactly exam related question, we will ignore the other three rates and we will also stick to this one. But the procedure, what to buy and what to sell, will be explained by me. Assuming that there are no transaction cost, advise the company how to avail the arbitrage gain from the above quoted spot exchange rate. Arbitrage gain. You have to take one quote from each market. So I have taken this quote, GBP INR, then USD INR, and then GBP USD. Okay. I have dollars with me. I can keep any quote out of these three as it is, and then try to find out the same from the cross market. So since we have the dollar, we can keep this quote as it is. Am I right? We might be from India, so we will keep USD INR and we will try to find out USD INR from the other two markets. Have a look. So what should be the procedure? Question number 31. I am keeping the direct rate of USD INR here from the Mumbai market, which is 64.10, and then I will try to find out the same USD INR rate from the other two markets. How to create an equation of cross multiplication for this? USD has to be kept first, the second currency will be GBP, multiplied by GBP first, the second currency will be INR. Am I right? USD should be first, INR should be last. Now, whether the rate is USD GBP, see, this is GBP USD, not USD GBP, right? So we have to take the inverse of that. Okay, we will convert it into indirect, and at that time it will be written as this. And the second quote is GBP INR, right? GBP INR as it is, we can keep it as it is. Let's put the values. 1 divided by 1.15530. 5530 multiplied by 99.10. Let's try to solve it now. 63.8112. Now understand that you have dollars with you, right? And the dollar itself is the base currency. Dollar itself is the base currency in both the quotes. If you go directly, then it will cost you 64.10. If you go through this cross market, it will cost you 63.8112. So tell me, in which market that you should buy dollar and you should sell dollar? In this market, you should sell dollar because the rates are high. And in this market, you should buy dollars. Isn't it easy? Now you already have the dollars. You don't have to buy it to start the transaction. You will have to sell those dollars to start the transaction because you already have it in your account. So you will start with this rate. Sell USD at this rate and keep going on. So the transactions will be like this. Sell USD in Mumbai market. So you have, I think, $20 million. I think we can now solve the question from this answer, institute's answer. In Mumbai market, they are buying rupees, means selling dollar. That's what we are saying, that sell the dollar in the Mumbai market. So 20 million into 64.10, you will get this much of the rupees, 128 crore 28 lakh. Now the rupees has to be exchanged. You have completed with this market. Now take the rupees and go to some other market where the rupees can be exchanged. Now the rupees can only be exchanged in this market, right? GBP INR in this market. So exchange that rupees and buy GBP. This is also rupees. 128 crore is also rupees. Both will be divided. 128 crore divided by 99.10, you will get the GBP. Now take the GBP and go to the rest of the market, because this is also over now. Go to the third market and exchange it for the dollars. Once again, this is dollar, right? 1.55, and this is GBP. You will multiply both of them and you will get the dollars back. You invested $2 million and you are left with, you invested how many? $20 million, sir. And you have received, you are left with $20,090,272. So the arbitrage gain is 92.72. So I will tell you, these transactions are very easy, because you will start with one market and then you will shift to the other market, and then the rest of the market you will keep selling something and buying something. But the major point is to decide where to sell that US dollar, 20 million. By looking just at the table, you could have sold those dollars in the Mumbai market and the New York market as well. If you would have sold the dollars in the New York market, it would have been a loss related transactions to you, not a gain. So it is very important to decide in which market the dollar is cheaper, available at a cheaper rate, and in which market it is available at a higher rate. Wherever it is cheaper, buy the dollar from that market. Wherever it is available at a higher rate, sell the dollar in that market. So we sold the dollar in the Mumbai market and bought the dollar in the New York market at the end, and which left us with some arbitrage gain of $90,000. Okay, sir, let's move on to the next question now. Question number 33. Citibank quotes JPY USD 105.106.5. There is one major mistake in the question. The way the quotation has been given for the exchange rate between USD and Japanese yen is wrong in this question. Because I have some practical knowledge, I know one thing, that Japanese yen is a weaker currency than dollar. So you should also have some practical knowledge of which currency is stronger than the other currency. Japanese yen is weaker than the Indian currency as well at present. Okay. So that is very important for you. Now this was the question asked in RTP. It was never asked in the exam. So what you can do, if the similar question is asked in exam and you know that the quotations are wrong, then you can put a note in the exam that the way it is presented is wrong and the ISO format is this and this. Although the answer is correct by the institute as well, but the way it is presented, it is wrong. Actually, it should be presented in this manner. It should be USD JPY. So 105 JPY for $1 is reasonable to understand, and this is JPY USD. So $0.0090 per Japanese yen is also reasonable. Now, the quote of Citibank states that dollar is the base currency, but the quote of Hong Kong Bank states that Japanese yen is the base currency. Okay. Are these quotes identical? If not, then how they are different? No, sir, these quotes are not identical, because one quote has USD as the base currency and the other quote has Japanese yen as the base currency. No, while Citibank quotes is a direct quote for Japanese yen and the Hong Kong Bank, it is a direct quote for dollar. Obviously, the price currency. This is the price currency. So if you look at from a direct quote angle, direct quote is always home currency per unit of foreign currency. Home currency per unit of foreign currency. So home currency is the price currency in a direct quote. So in this quote, we can clearly say that Japanese yen is the price currency. So this quote is direct for Japan and indirect for USA. This quote is direct for USA and indirect for Japan. So both the quotes are different. So they are not identical, practically speaking. Is there any possibility of arbitrage? Yes, sir. We can find out by calculating one of the rates. See, you just have to inverse one of the quote. Let's do that. And you know one thing, when you convert a direct quote to indirect quote, bid will be transferred to ask will be transferred to bid. Okay, let's do it with this one. Let's do it with this one. So if I make it USD JPY, I will just write 0.001 divided by 0.0093, which is the ask here on the bid side. 1 divided by 0.0093. So that's 107.53, and 1 divided by 0.0090, and that's 111.11. Now you compare this rate with the rates by the Citibank. You can clearly see that the Citibank's rates are lower than the Hong Kong bank rate. That means, and in both of them right now, USD is the base currency now in both of them, because we have converted the other one. Dollar is the base currency in both of them, and Citibank rates are lower. So it's easier to buy, or it's cheaper to buy dollar from Citibank and sell it in the Hong Kong bank to have some profit. Arbitrage is possible when both the rates are not identical. See, since Citibank quote implies this much and both the rates exceed those offered by the bank, there is an arbitrage opportunity. Or in other way, this is one way. We have solved it through this way, 107.53 and 111.11, and both the rates exceed the quote by Citibank, means the Citibank rates are lower, and hence the arbitrage opportunity is available. Now you tell me, in which market you should buy the base currency? In both the quotes now, our base currency is dollar. In which market you will buy the base currency? In whichever market the rates are lower. So start from this market. Citibank has a lower rate for dollar than the Hong Kong bank. Buy the dollar in this market, and for that purpose you will have to sell it. So let's read the question. If there is an arbitrage opportunity, then how would you make a profit from the given quotation in both cases if you are having Japanese yen or dollar? So we want to buy the dollar from Citibank. We will take this situation that we have 1 lakh Japanese yen. So what are we going to do? We will sell that Japanese yen and buy dollars. Let's see. $33. Buy USD with Citibank. So you have Japanese yen 1 lakh divided by, because the values by the Citibank also consist of the Japanese yen itself. We want to buy dollar, the base currency is dollar. We want to buy dollar, bank wants to sell the dollar, the rate available will be 106.50. Am I right? Ask rate. I want to buy the base currency dollar because it is available at a cheaper rate. Bank will sell dollar. So if the bank will sell dollar, ask rate will be applicable, 106.50. How many dollars will I receive? $938.97, and then I am going to sell USD with the other bank. Multiplied by. Why multiplied by? Because Japanese yen is the price currency. I want to sell the dollars. Dollar is the base currency. Bank will buy dollars. Bank will buy dollars. So bid rate is applicable, 107.53. You will get back the Japanese yen of 1,967,000. What is your arbitrage gain? It's simple, sir. You invested 1 lakh Japanese yen and now you have 1,00967 Japanese yen. Am I right? So 967 JPY is your profit. Simple calculation. Let's see what the institute has done. 967.44 Japanese yen is the profit. See, the transactions are not that important. Deciding in which market to buy and in which market to sell is very important. And please keep in mind, in case of arbitrage, always buy the asset or the base currency in a cheaper market and sell it in the higher market to make some profit. If you do exactly the reverse, you will have losses. An arbitrator will never do such type of transactions where he has to incur losses. So be careful from the very first step. You cannot try and fail. You have to be very confident from the very first step that the ultimate result should be arbitrage gain. Now let's have a look on this question. Question number 34. This is also an interesting question. Take this as homework. You can easily solve it. In this question, arbitrage is not possible. You can just try solving it. It's easy. And then let's shift to question number 35. This is something interesting. Now, see. The spot rate for dollar is given to you in terms of rupees. So can I say the base currency is dollar in this case? This is rupees per dollar, 48.0123. It is written in symbol. The base currency is this. This question is easy because first, it is not in two-way quote. It is just a one-way quote. Second, the best part that we are going to do in this question is we are going to use the interest rate differential for the arbitrage. Till this point, it was very easy for you to decide which currency to buy and which currency to sell for the arbitrage. Okay, currency arbitrage with cross rate. So till question number 33, it was an easy part. But from question number 34, you are going to solve the arbitrage transaction with interest rate differential. So with the help of interest rate differential, you will have to understand which currency to buy and which currency to sell, which currency to borrow, which currency to invest. And with the help of that, you will be borrowing a currency from one market, investing it in other market, and in that case, you are going to make a profit in the entire. So this concept that we are going to learn is an extension of the interest rate parity theory. If you remember, while discussing the interest rate parity theory, let me just go to that point. While discussing the interest rate parity theory, I had explained you that this can be the situation. We are going to compare the actual forward rate with the theoretical forward rate, and if it is equal, then there are no arbitrage opportunity exists. But if it is not equal, then the arbitrage opportunity exists, and we can easily calculate that which currency to borrow and which currency to invest in case of this type of situation. But there is another way which involves interest rate differential, and we have to learn that. This is probably the most difficult part of the Forex, and I'm going to take a break and I will be back with that concept. I will explain that concept first and then I will get back to the questions. See you. Welcome back everyone after this break, and in this part we are going to discuss about the most important topic of our Forex chapter. This is the arbitrage with interest rate parity theory using the interest rate differential. Now, let me just start the concept along with this question. See, the spot rate for the dollars are given to you, which is rupees per dollar 48.0123, and 180 days forward rate is also given to you, forward rate, that is 48.8190. So today the rate is that. For tomorrow, the rate is also given, for which you can enter into a contract today. Annualized interest rate for 6 months rupee is 12% and for 6 months dollar is 8%. Okay. Is there any arbitrage opportunity? Now, with these four figures, spot rate, forward rate, interest rate of home currency, interest rate of foreign currency. With these four figures, can you find out whether there is an arbitrage possibility? Yes, sir. Interest rate parity theory applies in this case. Please pay 100% attention to what I'm saying, at least in this lecture. So interest rate parity theory applies in this case, and it says that according to interest rate parity theory, if there has to be there should not be any arbitrage possibility, then the forward premium or discount, understand, the forward premium or discount in the spot and forward rate should match with the interest rate differential. That's it, approximately. So let's first find out what is the forward premium in dollar. Let's focus on the dollar, which is the base currency, which will be easy for us. Even if you calculate the discount, still the answer will be same. So no matter which point, which side you take, the dollar side or the rupee side, the answer will be same. To make the calculations easy, we will keep the side of the dollar. So we are going to calculate the premium or discount in a dollar, which is a base currency. The formula for base currency is forward minus spot by spot. Am I right? You can see 48.8190 minus 48.0123 divided by 48.0123. So if you calculate the premium, it comes to 1.68%. Let me just do it again. Yeah, 1.68% for 6 months, because these rate, the difference is 180 days. And the interest rate differential for 6 months is, can I say, 6% to the interest rate of Indian currency and 4% for the dollar. So the premium in this case, interest rate differential is 6 minus 4, that is 2%. Now you can clearly see that the premium in interest rate, the premium in the forward market, the dollar premium, the dollar is at premium, right, is not equal to the interest rate differential. Both of the figures are different. If it would have been equal, then we would have said that there is no arbitrage opportunity. But since both of them are not equal, we can say the arbitrage opportunity exists. So we have the answer to the first question. Is there any arbitrage opportunity? Yes, sir, there is an arbitrage opportunity. Now, in every question, whenever you have to find out the arbitrage opportunity, you will have to first calculate the forward premium or discount between the spot and forward rate and take the interest rate difference. But please make sure that the base or the timing of both is same. So in this case, you can see both of them are for 6 months, not per annum, right? Okay. We are done with this part. Now the second, if both of them matches, then there is no arbitrage opportunity. If both of them are not equal, then there is an arbitrage opportunity. If there is an arbitrage opportunity, the next question is which currency to borrow and which currency to invest. From which country I should borrow money and in which country I should invest money, so that I end up with arbitrage gain and not loss. Because if you do it otherwise, then there will be a loss. So you should be very confident about the first step, which currency to borrow or invest. And for this purpose, the two statements that I have written under interest rate parity theory are going to help you. This is the first step to find out whether there is an arbitrage possibility. Now the second step is this. Come to the part of interest rate parity theory. Now focus on what we have written here. Interest rate in a country, if the interest rate in a country is high, the currency of that country should depreciate. Now this is the procedure to achieve equilibrium, right? Achieve equilibrium means achieve no difference between these two. Achieve equilibrium means both of them should be same. Now, only then the arbitrage opportunity will stop. So when I say that the currency of that country will depreciate, that means it is going towards equilibrium point if the rate in that country is high. So let me tell you the arbitrage transaction. High interest rate, in the first impression of the high interest rate is investment. Everyone wants wants high interest rate for their investment and low interest rate for their borrowing. So understand, we will continue with that logic itself. If the interest rate in a country is high, the currency of that country will depreciate, will start depreciating, and equilibrium will be achieved when the depreciation in the currency of that country where the interest rate are high should be equal to the interest rate differential. The depreciation means the discount. So when the discount in the currency, in this case rupees in our question, so discount in rupees should go up till this point, 4%. Until that point, we will keep on investing in the high interest rate currency. Got it? So let's say, for example, the currency, Indian currency start depreciating and it depreciate by 2%. Still, we will invest in this because 2% is lesser than 4% of the interest rate difference. Let's say the interest rate, the rupee depreciates by 3%. Still, we will keep on investing in Indian currency because the interest rates are high. Because 3% of the depreciation is still less than 4%. Now let's say the depreciation in Indian currency goes to 4%. Now it is matching with the interest rate differential. Since it is equal to the interest rate differential, you cannot do the arbitrage transactions now. Arbitrage transactions was possible only till this point. Till the depreciation in that currency is equal to this, or the appreciation in the dollar is equal to this. So, understand. Now, let's take an example that the depreciation in Indian currency is 5%. 5%. It is more than the interest rate differential. Earlier it was lesser than the interest rate differential, then it came to equal to the interest rate differential. Now it is more than the interest rate differential. So understand, if the depreciation in the high interest rate currency is more than the interest rate differential, then you have to do exactly opposite. So instead of investment now, you will start borrowing. So borrow at high interest rate currency. Start borrowing at high interest rate currency and you will end up with arbitrage gain. So you understood the procedure. The first thing is the currency of that country should depreciate till this point. So till that point, you will keep on investing in high interest rate currency, borrowing in low interest rate currency. But once this point is achieved, no arbitrage is possible. And beyond this point, you will have to do exactly opposite. Instead of investing in high interest rate currency, you will start borrowing at high rate and investing at low rate. Still, you will earn profit. So there will be a timeline. I will just explain that. Now let's think from the angle of the dollar. So dollar is a low interest rate currency in this question, right? And the premium in the dollar is at premium, right? How much premium? 1.68%. So the premium in the dollar should be equal to the interest rate differential, and until it achieves the interest rate differential, we will keep on borrowing at low interest rate. So you can see in this question, we are very close to achieving the interest equilibrium point, right? 2% is the target. 1.68% is already the premium in dollar. Let's increase that to 1.70%. Still we will borrow in dollar. 1.80% we will borrow in dollars because it is low interest rate currency. 1.90% we will keep on borrowing in dollars for the arbitrage gain. 1.99% we will keep on borrowing in the dollars for the arbitrage gain. 2%. Now the 2% is the premium in dollar, 2% is the interest rate differential. You cannot borrow in any currency and invest in other currency to have arbitrage gain. Arbitrage gain is not possible. Okay, so you're slowly going this. So in that entire phase, you had a borrowing in the low interest rate currency. When it is equal to interest rate differential, no arbitrage. Now let's take the premium in dollar is 2.05%. It is more than interest rate differential. And now you will have to start doing exactly opposite. Instead of borrowing in dollars because of the low interest rate, invest in dollars. 2.10% invest in dollars. 2.20% invest in dollar. Let's take an example that reduce that 1.68%. Reduce that 1.68% to 1.5. You will keep on borrowing unless and until, like, at any point below this, you will keep on borrowing at lower interest rate, even if that rate goes to minus. Let's say, for example, the answer comes to minus 1.68%. That means it is not at a premium, it is at a discount. That means it has gone to some this level, minus side. Still you will keep on borrowing in dollars. All that entire phase from the positive 1.68 to 0 and then minus side also, you will keep on borrowing in dollars. The condition is you will keep on borrowing at low interest rate until the premium, because the low interest rate currency should be at premium, until the premium of that low interest rate currency equals to the interest rate differential. And beyond this point, you will start doing exactly opposite. Obviously, I understand that it is very difficult to remember all these things, and you should be expecting something in return for this. I have a very good chart for this. You can find that on the Telegram channel as well. Whenever you will type interest rate differential in my Telegram channel and keep on searching, you will find that chart. Have a look on this chart now. So this is the entire chart that you have to consider. The very first step is, I'm just going from the beginning and revising the entire thing. The very first step is calculate the interest rate differential and then find out whether the forward premium or discount is equal to the interest rate differential. If it is equal to the interest rate differential, then there is no arbitrage gain possible. Okay. But if it is not equal to the interest rate differential, then obviously arbitrage opportunity exists. If it is not equal to, that means it might be higher or lower. But whatever it is, understand, if it is not equal to, the only thing that you have to remember is borrow at low interest rate currency. See, this is a general concept of a rational person, that he would want to borrow at a low rate and invest at a high rate. So take this concept, borrow at a low interest rate currency until, this is very important, don't ignore this particular word, until the premium. Why the premium? Because interest rate parity theory says that low interest rate currency should be at a premium. So borrow at a low interest rate currency until the premium in that currency equals the interest rate differential. If you cannot remember this, you have to mug up this. And if you even cannot remember this, I have the third option for you. You just remember this diagram. Now, if we think from the low interest currency point of view, you have to remember that it should be at a premium, and the premium should be equal to the interest rate differential. Now, if we create a timeline like this and put discount on this side and premium on the other side, see, premium on this side, discount on this side, and the center will be 0. If there is no premium or discount in the currency, let's say spot rate is 50, forward rate is also 50, then the premium and discount will be 0, right? In that case also arbitrage is possible. So understand, the very first thing is, when you talk about low interest rate currency, it should be at a premium. So we will keep a point of this. So this is the point of equilibrium. That the interest rate differential should be equal to the forward premium. Now understand that low interest rate currency, if the actual premium that you are calculating lies anywhere in between this, So our interest rate differential in this question that we are discussing is 2%, right? In the dollar, which is the low interest rate currency. So can I write it 2% here? So this is the 2%, and the actual forward premium is this 1.68%. Now you can clearly see that until we reach this point, we will have to follow this green line. Green line means borrowing. Borrow at a low interest rate currency. So even if it is a discount of minus 6%, still it is lower than the premium of 2%. In this entire phase, you are going to borrow at dollar. And once this phase is crossed, or once the premium is more than the interest rate differential, you will have to follow this process, that is investment. So see, you will start from the discount. You will have to borrow at low interest rate currency. If the low interest rate currency is at discount, how to read it? If the low interest rate currency is at discount, interest rate parity theory says that low interest rate currency should be at a premium. So if it is at discount, then it is way far from achieving the equilibrium. Okay, so if it is at discount, borrow in that currency. If it is at premium, see, if it is at premium but it is less than interest rate differential, this is the phase. It is at premium but less than interest rate differential, that means 1.68%, then still you will borrow at dollar. And if it is equal to interest rate differential, means this phase exactly. That means no arbitrage is possible. And if it is beyond interest rate differential, if the premium is more than interest rate differential, then you will start investing, exactly opposite of what you were expected to do. You can follow low interest rate currency, you can follow high interest rate currency as well. Okay, let's talk from this angle. When you talk about the high interest rate currency, the first thing that comes to your mind is investment. And you will keep on investing in the high interest rate currency. But IRPT says that it should discount. It should be depreciating until it reaches the interest rate differential point. So it should be at discount, rupee. In this question, rupee. Now, discount means this side, right? So if this is the interest rate differential, unless and until the actual discount in the high interest rate currency reaches to this point, reaches to this point, from that point, you will keep on investing at high interest rate. Whatever the rational person is expected to do. Once the discount in high interest rate currency is equal to interest rate differential, no arbitrage is possible. And if the discount is more than the interest rate differential, then you have to do exactly opposite, which is borrowing at high interest rate currency. So let's talk from this angle once again. Low interest rate currency. In this question, 1.68% is the premium, and that's why we are investing. If the premium would have been 2.5%, now we would have started investing in dollar. If it is 1.68%, we are borrowing at low interest rate currency. Whatever the rational person is expected to do at low interest rate currency. But if the premium is more than the interest rate differential, you will have to do exactly opposite at that currency. Invest in dollar in that case. So you will have to practice this a lot of time to understand the logic. If you understand this logic now, this is very easy, sir. Very easy. The very first thing that you should remember is low interest rate currency is expected to be at a premium, and the premium should be equal to this much. If it is not a premium, if it is discount of, let's say, minus 2%, what will happen? You will say that, okay, 2% is matching. No, it's not matching. I will tell you it's not matching. Low interest rate currency should be, see, I will just remove all this. You might get confused with minus 2%. No, sir. If the dollar is at a discount of 2%, then still it is not matching with the interest rate differential, because it was expected to be at a premium. I will tell you how. See, the dollar is expected to be at this point, which is 2% premium, but the dollar is exactly at this point, which is minus 2%. how can you expect that the equilibrium is achieved? Equilibrium is only achieved at this point, and before that you have to borrow. So it is at a discount. Whatever is the discount, doesn't matter. If it is at a discount, you will borrow low interest rate currency. If high interest rate currency is expected to be at a discount, and if it is at a premium, then you will invest. If it is at exactly opposite situation, then the question is very easy. Only when it is expected at discount and it is at discount, then one of the three situation will have to be understood. That's very simple, sir. Now come to this question. We'll solve some question with this logic, and then we will have some practice on that. So you can clearly see that a couple of things that I think I should write. First of all, and I will try mostly to solve the question from low interest rate currency, so that I follow one particular system instead of high interest rate currency. So low interest rate currency, which is dollar in this case, is expected to be at premium. Therefore, until the premium in dollar is equal to interest rate differential, we are going to borrow that dollar. We are talking about dollar itself. Simple question. What exactly now you want? It is not equal, na? So we will borrow. And beyond means premium is greater than, premium in dollar is greater than interest rate differential, then you are going to invest. In both the situation, you will have some arbitrage gain. In this question, the very first condition is satisfied, that premium in dollar is less than interest rate differential. You can just keep yeah, that's okay. Otherwise, though, the entire mugging up will not help you. So I'm just skipping that part. I was about to say that. So can I say that the premium is not equal to the interest rate differential, and it is lower than the interest rate differential, so we will borrow in dollars, and that's it. The question is solved now. You can start borrowing the dollars. Now let me complete the question. If he is willing to borrow rupees 40 lakh or US dollar 83,312, my answer is to borrow dollars, so I will go with this part. Further, should arbitrager go for covered interest rate arbitrage if he has forecasted the spot rates of 180 days hence as below? I will talk about the covered interest rate arbitrage and uncovered interest rate arbitrage after this particular calculation. So first we will go with this calculation. In exam, you should write this particular statement after this statement, and then you will start writing the arbitrage transaction. What we are going to do, we are going to borrow dollar for 6 months today from America. We will bring that in India, convert that in rupees. Okay. And what are we going to do? We are going to invest that. If you are borrowing in dollar, invest in rupees. Invest that for 6 months and take the forward contract. After 6 months, receive 6% on that in Indian rupee and sell those rupees at this forward rate to get the dollar. Whatever the dollar you have received, make the repayment of this borrowing out of that dollar, and you will be left with the arbitrage gain. Have a look. First part, second part, and I'm directly starting the arbitrage transaction at time t0. Borrow dollars, so we will receive $83,312. Sell dollar at spot. After borrowing, we will convert that, so we will give 83,312 and we will receive rupees. So $83,312 at spot rate of 48.0123 comes to 40 lakh. Okay, and we are going to invest that in India. Am I right? What else I am expected to do that for 6 months? And again, I will buy forward because I want to buy dollars at the end by selling rupees. I will buy forward for 6 months. So these are the transactions that I'm going to do. Just imagine you have borrowed money from America, brought it to India, the dollars. You will sell those dollars, receive Indian currency, invest Indian currency, and since you know that after 6 months you will receive rupees, with that you would want to buy the dollars back, so buy forward. What will happen after 6 months? There are only two positions open, this one, and this one, three positions. So investment proceeds, can I say 40 lakhs into 1.06? That's what I will receive, 42 lakh 40,000, and buy dollars in forward, whatever you have agreed. So you will pay entire 42 lakh 40,000. You can keep the balance amount in rupees if you want the gain in rupees, but let's see, 42 lakh 40,000, and you will receive the dollars with that 42 lakh 40,000 divided by the forward rate that you agreed to buy the dollar at 48.8190. So you will receive the dollars 86,851.43, and now repayment of dollars that you have borrowed. How much did you borrow? You borrowed 83,312, and that too at 4% for 6 months. That comes to the repayment of 86,644.48. You can clearly see we have a gain of arbitrage here, that's $206.95. There is another way to have a gain in the rupees. What you can do is you can calculate the repayment amount first. That means you need $86,644.48. You need $86,644.48 to make the repayment. Pay rupees of that much amount only. Pay rupees so that you can borrow, you can buy only 86,644 under the forward contract, and the balance rupees will be kept with you as a gain. So I will just show you. 86,644.48 rupees is required to make the repayment of the dollars. I'm going to buy this much of the dollars only in the forward contract. So that will be 48.8190. And for that purpose, I will only have to pay 42,298.97. Right? So what will happen here? It will be 86,644.48 minus 86,644.48. So the dollar will be received, the dollar will be paid off, and I will be left with 42 lakh 40,000 minus 42 lakh 29,000. 42 lakh minus 42 lakh 29,897. So I will be left with a profit of 10,103. Which is exactly equal to 48.8190. Yeah, this rate multiplied by the dollars. So if you want a profit in rupees, you can do it like this, or in dollar you can do it like that. Have a look. $206.95 is the gain. $206.95 is the gain. So this is how you have to do it. This is not the important part, sir. Once you start the procedure, you will automatically get to know that what should be the next step. The most important part is to decide whether to borrow in dollars and invest in dollars. The first step. After that, all the other steps will follow. Okay, sir. So this was the question. Now let's talk about the second part of this question. Now understand. Further, should arbitrager go for covered interest rate arbitrage if he has forecasted the spot rates after 180 days to be like this? Now tell me one thing. In our equation, you focus on this point, this transaction. I borrowed the dollar from USA, sold it in the spot market in India, received rupees of 40 lakh and invested the same. Why do you think I have bought this forward? Why do you think I have bought this forward? Let me tell you. I knew that this investment will mature after 6 months and I will receive 42,40,000 rupees. Okay. I also knew that I have to make the payment of this borrowing after 6 months. So this is for sure that I have to make the payment of this dollar along with the interest, which comes to 86,851.43. Because it was confirmed that after 6 months I will have to buy this much of the dollar so that I can make the repayment. Sorry, 86,644.48. This one. Because it was confirmed today itself, because I borrowed, that I will have to buy the dollars after 6 months to make the repayment of the dollar. There were two options that I could have followed. I can basically fix the rate of buying this dollar today itself. That is called as buying the forward. What I did is I covered myself for this transaction as well, which was 100% sure to happen after 6 months. So I did not want to buy that much of the dollar to make the repayment. I did not want to buy this much of the dollars at the spot rate of 6 months. Because who knows, the spot rates are not in your favor, then what will happen? Even if you do not buy the forward contract, there is another option to cover up this repayment, is buy this much of the dollar at the spot rates of 6 months. But that is like keeping the position unhedged. That is like not covering yourself for the probable purchase of the dollar. If the rates are in your favor, then it's well and good. Your decision of not hedging, not covering will go in your favor. But if the rates are very high on that date for the spot rate, then you will not have any option but to buy this much of the dollar at the spot rate. All in all, if you are confirm about the probable purchase of the foreign currency at some future date and you are making sure that you are fixing the price of that transaction today itself, that means this is called as covered interest rate arbitrage. Covered interest rate arbitrage. But if I remove this transaction from this statement, what will happen? If I do not buy the forward, that means I am not covering my forward transaction. That is for sure to happen. So at the time of 6 months, at the end of 6 months, at the time of making the repayment of this much of the dollar, I will have to go to the spot market of that date and have to borrow $86,644.48 at the spot rate. That's called uncovered interest rate arbitrage. Because I did not cover myself at time 0 for the probable purchase, that's uncovered. Since I covered here, this is called as covered interest rate arbitrage. So the thing that you have learned here is called as covered interest rate arbitrage. If you do not take the forward contract, you will have to this rate would have been the spot rate of the 6 months. And then it would have been called as uncovered interest rate arbitrage. Because you relied for the purchase of 86,644, you relied on the spot rate of that date. And that's what is given in the question. If you go with the uncovered interest rate arbitrage, you will have to convert your dollar at this rate, which is like there are 3 different possibilities for the same. The very first step is to find out the expected spot rate. Multiply the rates with the probability and you will get a expected spot rate. Let's find out. See, so when you multiply it with the probability, the expected spot rate seems to be 48,7930. Now understand through this timeline. This is spot, this is forward. So this is the expected spot rate 7930 and 48.8190 is the forward rate for the same date. And what is the spot rate today? 48.0123. So I'm talking about those dollars that you have borrowed, 83,312. Along with interest, it will become 86,644. Am I right? 0.48. Since we have borrowed the dollars today, it is for sure that you are going to make the payment along with the interest on that date. Now it's up to you. You can, since you know it from the very beginning, you can cover this purchase under the forward contract, and you can keep it open and buy those dollars at the whatever spot rates at. This particular part is called as covered interest rate arbitrage, and this part is called as uncovered interest rate arbitrage. Are you okay with the concept now? Covered means hedged, uncovered means unhedged. Now we have to find out that if we do not cover the forward and keep the position open, so this will be the rate at which we will be buying the dollars. Let's find out how much would have been the total at that time. And we will go with this particular part. So we will find out at which rate we would have sold 42,40,000 rupees. We would have sold this 42,40,000 rupees at the expected spot rate of 48.717930, and you can clearly see that 42,40,000 at 48.7930, the expected spot rate would have given you this much of the dollar. This is uncovered portion if you go without coverage. But if you go with coverage, 42,40,000 divided by the forward rate was the answer that we calculated, 48.8190. And with this you will get a dollar of 86,851.43. Both of them as your inflow. Now you tell me, receiving 86,897 is better or 86,851 is better? Because in both the case the repayment amount will remain same, which is 86,644.48. See, 86,644.48, 86,644.48. So this is our current gain, which is $206.95, and this is going to be the new gain, which is going to be 253.23. Obviously, we would prefer for the higher gain, 253.23. So it's better not to cover the foreign currency exposure. So better to go with the uncovered interest rate arbitrage than to go with the covered interest rate arbitrage. Let me just write it down. This is called as uncovered interest rate arbitrage, and this is called as covered interest rate arbitrage. Do you get that? But I will tell you one thing. The difference is a small, like it is $207 almost, and this is $253. Mathematically speaking, we should go with the uncovered interest rate arbitrage because the gain is higher in that case. Do not take the forward contract, leave it to the spot rate. But these rates, 48.7930, are expected spot rate. It will change for sure in reality, but this forward rate is a fixed rate which you can fix today. So this is a guaranteed gain and this is non-guaranteed gain. Now you decide which you want. See, read it with me. Since the expected gain is more in case of uncovered interest arbitrage, the arbitrager should go for the same, means keep it open. However, this gain is slightly higher than the covered interest rate arbitrage. Hence, he may not go for uncovered interest rate arbitrage as this is not guaranteed, as the chances of actual spot rate may not turn out favorable. Obviously, because this is not guaranteed. This is just an expected rate multiplied with the probability. Do you think exactly this is going to happen? No. So this is unguaranteed gain and that is guaranteed gain. You decide which gain do you want. I will still go with the guaranteed gain because the difference in both is very small. So why to be like going for this is like being greedy just for the purpose of that $40 extra, right? You understood the concept. Let's move on to the next question. We will solve once again the same thing and we'll move on. I want you to be strong on the concept of which currency to borrow and which currency to invest. Have a look on this question now. See, spot rate of $1 is in rupees 68.50. I will just quickly get through this question because I'm not that interested in it. Nothing to learn because except for the concept that we want to make like have a grip on. So rupees per dollar is 68.50. USD premium on 6-month forward is 3%. Already the premium in dollar is given to you. Annualized interest rate is US 4% and 9% in India. This will be considered as per annum. This is the premium for 6 months, 3%. So if you take the 6 months rate, it is going to be 2% and this is going to be 4.5%. Okay. Is there any arbitrage possibility? See, what is the difference in the interest rate? Interest rate differential is IRD is 2.5%. What does that mean? It means that the low interest rate currency, which is US dollar, should be at a premium of 2.5%, and until it goes till 2.5%, we will invest in the low interest rate currency, and if it goes beyond 2.5%, we will borrow low interest rate currency. That's what the question is. And you can clearly see that in this part, the premium is more than the interest rate differential. We wanted only 2.5% of the premium in dollar, but it is more than that. What will you do? You will invest in dollar, low interest rate currency. Investment in dollar will only give you arbitrage gain, otherwise not. So how a trader can take advantage of the situation if he is willing to borrow USD 3 million? If he is willing to borrow $3 million, so no, borrowing the dollar will not give you profit. It will give you only loss. Investment in the dollar is only possible for the arbitrage gain. See. Why so much of the clutter? Spot rate and an interest rate differential is less than forward. There is a possibility of arbitrage outflow. Okay, the advantage of the situation can be taken in the following manner. Borrow. See, borrow equivalent amount of dollar in India. Don't borrow dollars. Don't borrow dollars. Borrow the equivalent amount of this much in rupees in India. So you are actually borrowing 20 crore 55 lakh rupees. 20 crore 55 lakh rupees. And if you will go this way, you will have a profit. I will just show you. So you will borrow rupees. How much? 68.50 into $30 million. They say 30 million. So equivalent amount in rupees we are going to borrow into 68.50 comes to 20 crore 55 lakh rupees. This much of the rupees will be borrowed, 20 crore 55 lakh. Then we will convert that at spot. So we will give this much of the rupees 55 and we will get the dollars. How much? Exactly $3 million we will receive, and we will invest that dollar in US. So again it will be invested. The total is 0. At time 0, it is 0. Okay. Now, what will happen at expiry? We know that we are going to receive the dollars with interest and we will be selling those dollars after 6 months. So we will sell forward today itself. The forward rate can be easily calculated by increasing 3%, 68.50 plus 3% comes to 70.555. Now understand what will happen after 6 months. You will receive interest on this. How much? 2% on the dollars. So 3 million plus 2% comes to 3.06 million. Let me write it here. So after 6 months, what will happen? You will receive the dollar 306. Okay. You will sell it in the forward contract that you agreed. So you will just pay that much and receive rupees. At what rate? Sir, 70.555. So multiply that. You will get around 21 crore 58 lakh 98,300. Now is the time to make the repayment. See, you did this one also, and now is the time to make the repayment of Indian currency. 20 crore 55 lakh plus 4.5% of the interest for 6 months. So repayment 20 crore 55 lakh plus 4.5% comes to 21 crore 47 lakh 47,500, and the gain is 1150,800, 11 lakh 50,800, and that's the gain. If the ultimate answer is gain, that means the first decision that you took for borrowing rupees or investment in the dollar was right. And this is in dollar that they have given, or 1166,100. 1166,100. I will tell you why they have reached at 66, because the actual rate is 70.555 and they have taken it as 56. It made the difference. Because of that, the difference is there, 1166, and our answer is 1150. So that 16,000 rupees of the difference is because of that rounding off. Do you understand this situation? And this is a classic example of when the premium is more than interest rate differential. I will just show you in that chart exactly where we are standing so that you will have an idea. I will remove everything like this. So we were talking about the low interest rate currency, right? And see, I will tell you. The interest rate differential, low interest rate currency means dollar. The interest rate differential was 2.5%, but actual premium in dollar was 3%. That means here. And you can see that it is in that red area. It is in that red area. That means premium is greater than interest rate differential. And that's why we are going to invest in the low interest rate currency. If we have a low interest rate currency investment, high interest rate currency borrowing, that means rupees should be borrowed. This is how we should take the solve the questions. Let's move on to the next question now. Fatafat. Question number 37. Again, one of the interesting question. Mary is a forex dealer with XYZ Bank. She notices the following information relating to Canadian dollar and German Deutschmark. Exchange rates of Canadian dollar and DEM Deutschmark is given to you for the spot and the 3 months as well. Okay. See. And the forward rate is Canadian 0.780 per Deutschmark. Interest rate for Deutschmark is 7% per annum. And Canadian dollar is 9% per annum. And focus on this time, 3 months. So what does that mean? Sir, it's very clear that we have to convert the per annum rate to 3 months rate. 7 divided by 4 comes to 1.75%, and 9 divided by 4 comes to 2.25%. Okay. Assuming that there is no transaction cost, determine does the interest rate parity hold in the above quotation. So keep this particular, there are two ways to clear this. You can calculate the theoretical forward rate and compare it with 0.780. If it is matching, then you can say that the interest rate parity theory is holding true, otherwise not. And the other way to do that is to compare the premium and discount in the base currency. We can take this one. What has happened? Just a second. So we can take the calculate the premium or discount in the base currency and compare it with the interest rate differential. If both of them are matching, then the interest rate parity theory holds true. If it is not matching, it is not holding true, and the arbitrage possibility is there. So let's try doing it. Let's calculate the premium. In base currency we are calculating, that means the formula should be F minus S divided by S, and that's 0.780 minus 0.775 divided by 0.775. That comes to 0.65%, right? This is the premium in Deutschmark. And what is the interest rate differential? 2.25 minus 1.75. The interest rate differential is 0.50. Both of them are not matching, right? Both of them are not matching, and hence the interest rate parity theory does not hold true. First thing. Second thing, you can clearly see that the premium in the low interest rate currency. What is the low interest rate currency? Deutschmark is the low interest rate currency. DEM. It should be at a premium according to IRPT. It is at a premium. Okay, it should be at a premium, and it should be borrowed because it is at a low, it is having a low interest rate. It should be borrowed until the premium goes till 0.50%. But we can see that the premium is higher than the interest rate differential. It should be at a premium, but the premium is higher than the interest rate differential. That means again the same situation as it was in the previous question. Instead of borrowing, we are going to invest in the Deutschmark, because the interest premium is more than the interest rate differential. I will just draw a line here. Understand, this is a premium side for the base currency or the low interest rate, for the low interest rate currency, and this is a discount side. Since you have chosen the low interest rate currency, it should be at a premium. How much? 0.5%. So let's say the 0.5% comes to this part. This is interest rate differential. Okay, but actual premium of this is 0.65%. And understand, this is the phase. If the premium is less than interest rate differential, you will borrow at a low interest rate currency. But if it is more, you will invest at the low interest rate currency. That means Deutschmark. So now we are going to invest. Okay. If yes, then explain the steps that would be required to make an arbitrage profit if Mary is authorized to work with Canadian dollar 1 million for the same purpose. Also determine the profit that would be made in Canadian dollar. So everything has to be done in the Canadian dollar. What is your answer? Sir, invest in the Deutschmark. So if we are investing in the Deutschmark, that means we are borrowing in the Canadian dollar. So what we have to do is we have to borrow Canadian dollar. Start with borrowing the Canadian dollar, convert that into Deutschmark, invest that amount in the Deutschmark at 7%, and take the forward sell contract. Because Deutschmark is the base currency, after 3 months you will receive the investment in Deutschmark. You will sell that Deutschmark and get the Canadian dollar. Out of that received Canadian dollar, you repay the borrowing and the balance will be your gain. I will just show you. Too much of the things have been done here, and see, these are the rates. I will just show you basic understanding. Borrow Canadian dollar at 9% for 3 months. Change this sum into DEM. So sell that Canadian dollar and receive the Deutschmark 1290323 at spot, I think. Yeah. And invest that Deutschmark in the money market for 3 months. That means investment. And after 3 months, what will happen? This is the principal that you invested. This is the interest for 3 months you are going to receive. 7% for 3 months. So you are going to calculate that. And this is what you will receive. Deutschmark at the end of the 3 months. You will sell this much of the Deutschmark after 3 months at the forward rate that you have agreed, 0.780, and the net amount that you will receive. Just a second. This is also not. and the net amount that you are going to receive in the Canadian dollar after selling the Deutschmark is 1024065. Find out the repayment. How much did you borrow? 1 million, that is 10 lakh at 1.75% for 3 months. So that's hardly 1017500. So it's like this is what you received, and the repayment will be 1017500. The balance is your gain. You can clearly see that the receipt is higher. So all in all, this procedure has to be just a second. Okay, that's my mistake. It should be 2.25%. So if we go with the 2.25%, still we will have some gain. 1022500, 1024065 and 1022500. 1024065, 1022500. This is inflow, this is outflow, and still you are left with the Canadian dollar profit. I told you the transactions are easy to understand. Once you borrow from a country, you will sell it in our country and get the other currency, invest that other currency, get that currency with interest after 6 months or 3 months or at a maturity, sell that currency again and make the repayment of the borrowings. You will be left with the profit. But deciding the very first step, whether to borrow this or this, is the most important part. Let's come to the question number 38 now. And I think this is the same. Canadian dollar versus Deutschmark. Canadian dollar versus Deutschmark. The rates are almost same and interest rates are almost same in this case. Cool. In this case also you can see the premium. The Deutschmark is at premium of 3%, but it should have been only of 2%. So again the premium is high. In case of this particular, this should be the point IRD. In this area you are going to borrow at low currency. In this area you are going to invest at low currency, and the actual premium is lying here. So you are going to invest in low currency. Low interest rate currency means Deutschmark. So borrow Canadian dollar, invest in Deutschmark, you will get the profit. Borrow Canadian dollar. See, I'm just leaving that question again. Question number 39. If there is something new, then I will talk about it. Why to waste it? Now this is something related to the forward rates that we have learned in the derivatives part, and that's easy. Have a look. The risk-free rate of interest in USA is 8% and UK it is 5%. Which is the low interest rate currency? UK pound. So UK is the low interest rate country. The spot exchange rate between the dollar and the pound is also given to you, and it is very clear that the dollar is the base currency here. Base currency. So if you want to calculate the premium or discount in dollar, the formula will be F minus S by S. If you want to do it in pound, it will be S minus F by F. We'll try to do it the straight way. We'll try to find out the premium or discount in the dollar itself, but let's see what has been given. Assuming that interest is compounded on a daily basis. Since the interest is compounded daily, you have been given with the values of E. That's it. Then at which forward rate of 2 year there will be no opportunity for arbitrage. Further show how an investor could make riskless profit. Riskless profit, that means arbitrage gain, if the forward rate is this much. We'll talk about it later, but let's first find out what should be the rate after 2 year. See, 1 year and 2 year. The spot rate today is 0.75 pound per dollar. Understand, if you take this rate, if you take this as a direct quote, then RD will be your, how much, which country, which currency? UK, that is 5%, and RF will be 8%. If you consider this as a direct quote is always written in terms of home currency, that is pound, per unit of foreign currency, that is dollar. So foreign currency is dollar. If the foreign currency is dollar, then 8% will also be the foreign currency interest rate. Okay? Clear with this? Now, The spot rate is 0.75 and we have to calculate the 2 years rate, theoretical rate where no arbitrage is possible. Now we used to write 1 plus r to the power 2 because of the 2 year and rd, and 1 plus rf to the power 2 is equal to f by s. Now what we are going to do is we cannot take the simple compounding. So instead of rd to the power 2 and rf to the power 2, we are going to write down e to the power rd into t, e to the power rf into t. That's it. Continuous compounding. So e to the power 0.05 into 2, e to the power 0.08 into 2 is equal to f divided by the spot rate is 0.75. Now, please make sure that the currency of this 0.75 and the currency of this 5% is same. Let's have a look. 0.75 is pound and 5% is also from UK, so it is also pound, and that means you have put the correct values. And this will be e to the power 0.10, e to the power 0.16 is equal to f divided by 0.75. So let's take the values of 0.10 and 16. Where is 0.10, man? Okay, the 0.10 is not given, but you can calculate e to the power 0.10 just by reversing this value. 1 divided by 0.9051. So e to the power 0.10 will be 1.1049. Just the inverse of this. We have learned this, that e to the power minus 0.1 can be converted into plus 0.1 if we reverse that. So 1.1049, 1.1735. And your f will be 0.7062. See, 0.706. To be more specific, 0.7062. This is the forward rate at which no arbitrage is possible. No arbitrage is possible. Now, further show how an investor could make riskless profit if 2-year forward price is this much. If the forward price is 0.85, see, if it should be 0.706, only then you will be at no profit, no loss, means you cannot make profit. But if this is the rate, then there are chances. How to proceed with that? Go with what I have taught to you. It's very simple. Calculate the premium. The spot rate is 0.75, forward rate is 0.85. Calculate the premium, and now this premium will be calculated for 2 years. Please remember that. 2 years. Let's do it here. And if you are calculating the premium, we will do it in the dollar. Understand? Dollar. That means base currency. And the dollar is high interest rate currency. You can clearly see it is at 8%. In this question, there are two things to note. Till this point, all the questions that we have discussed, the base currency was the low interest rate currency. In this question, the base currency is high interest rate currency. So first calculate the premium and discount. F minus S by S. Forward rate is 0.85. 0.85 and 0.75. See, this is going to be the difficult question for you. 0.75 divided by 0.75. So into 100, that's 13.33%, and that's the premium. But tell me, what is that premium? Dollar is at premium because you have calculated the premium in the base currency. Base currency is dollar. Dollar is at premium. Dollar is a high interest rate currency. So, since it is high interest rate currency, just a second. Since it is high interest rate currency, it should depreciate. It should depreciate to the point it is equal to the interest rate difference. And that 13.33% is the differential for 2 years. 2 years, remember that. So let me just take it. High interest rate. That means it should depreciate. So you can first of all, without doing anything, you can see that it should be at a discount, but it is at a premium. It should be at a discount and it is at a premium. It should be at a discount. That means we shall invest. We shall invest in the high interest rate currency until the depreciation in that currency reaches to the interest rate differential. But instead of depreciating, it is already at a premium. And what is the interest rate differential, sir? What is the interest rate differential? It is nothing but, I will just show you. We will have to calculate it for 2 years, right? So e to the power 0.16, that means 8% into 2, minus e to the power 0.10, that means 5% into 2 for 2 years. So 1.1735 minus 1.1049. 6.86%. Now understand the magic. Most of the students will take a wrong decision in this case. But the answer is very simple. First of all, the high interest rate currency should be at a discount, and right now it is at a premium. And if it is at a premium, straight away you can just go and invest at that rate, high interest rate. Let me show you. If this is the timeline, okay, this is 0, this is the premium side, and this is the discount side. Now understand, this is a high interest rate currency. It should depreciate to the point of 6.86%. So the depreciation means the discount. This is equal to IRD. So it should depreciate till this point, which comes to 6.86. But actually it is at a premium of 13.33%. Right? Now, what does the interest rate differential says that until the high interest rate currency is depreciated or depreciating by 6.86%, we are going to invest in that. And if it depreciates by more than 6.86%, we are going to borrow in that. Now, a lot of students going with the same logic will decide to borrow, because they will just compare that 13.33 is higher than 6.86%. They are not saying that 6.86% should be discount, 13.33% is a premium. If 13.33% would have been discount, then we would have borrowed at a high interest rate currency. But right now the question is very simple. We are coming in the investment area. Since it is high interest rate currency, the discount should be 6.86%, and until then we are going to invest beyond this rate. If the discount goes beyond this rate, we will borrow. So now we are going to invest in dollar. That's the ultimate result. Investment in dollar. So borrowing in the other currency. Now have a look on the question. Investment in the dollar and borrowing in the other currency. So you can clearly see that we are borrowing pound. By selling the pound, we will buy the dollar and we will invest the dollar, and at maturity we will have some cash inflows. Rest of the question is similar. You can take any values that you want for 2 years, and these are the cash flows you will be leaving with the profit. But make sure dollar is investment. That means borrowing will be pound. Okay. Question number 40 is our next question. Pretty interesting one. I will take a break and I will be back with this question number 40. See you, sir.